Every few weeks, a room full of the most powerful economists in the world sits down, looks at a single number, and decides whether to make it slightly bigger or slightly smaller. That number is the interest rate. And the metaphor everyone uses to describe what they're doing is almost universal, even among people who have never taken an economics class. The Federal Reserve is setting the temperature of the economy. Raise rates and things cool down. Lower rates and things heat back up. A thermostat for an entire nation's financial system. It's a clean metaphor, it's taught in textbooks. It's repeated on every financial news channel. And here's the uncomfortable claim at the center of this video. The thermometer the Fed is reading from is broken. Not catastrophically, not obviously, but broken in a specific, well-documented, and genuinely strange way that even many finance professionals quietly overlook. By the end of this video, you're going to understand something most people, including plenty of people who trade for a living, never fully grasp. Sometimes, when the Fed thinks it's cooling the economy down, it might actually be doing nothing at all. And sometimes, when it looks like it's barely touching the dial, it might be freezing the whole system solid. Let's find out why. Let's start with the metaphor everyone already knows because it's not wrong, it's just dangerously incomplete. When the Federal Reserve raises short-term interest rates, borrowing gets more expensive. Mortgages cost more. Business loans cost more. Credit card debt costs more. All of that friction slows down spending and investment across the entire economy. The system cools. When the Fed lowers rates, the opposite happens. Borrowing gets cheaper, spending picks back up, and the system warms. This is genuinely how the mechanism works, at a basic level. The Fed adjusts one number, and that number ripples outward into millions of individual financial decisions, nudging the whole economy warmer or cooler. It's a real, physical feeling process, which is exactly why the temperature metaphor caught on so naturally in the first place. But here's the question almost nobody asks, and it's the question this entire video is built around. When the Fed looks at the interest rate to decide how much to adjust it, are they actually reading the economy's true temperature? Or are they reading a thermometer that's been quietly, systematically distorted? To answer that, we need to introduce a concept that sits at the very center of monetary economics, the Fisher effect, named after economist Irving Fisher. Yes, the same Fisher whose conservation law equation we spent an entire video on. His fingerprints are all over this channel's entire thesis, and here they are again. The Fisher effect makes a specific, testable prediction. It says nominal interest rates, the rate you actually see quoted, the headline number, should move roughly 1-for-1 with expected inflation. If people suddenly expect inflation to run 2% hotter next year, nominal rates should rise by roughly 2% to compensate. Lenders need to be compensated for the fact that the dollars they get paid back will be worth less than the dollars they lent out. If you strip inflation expectations back out of that nominal rate, you're left with what's called the real interest rate, nominal rate minus expected inflation. And according to the Fisher effect, that real rate should stay relatively stable over time, because the nominal rate is supposed to be doing all the work of absorbing inflation expectations. In theory, this is elegant. It means the nominal interest rate the Fed watches so closely should be a clean, reliable signal, a genuine thermometer reading, with inflation already factored out. Let's sit with how clean this theory is for a moment, because the cleanness is exactly what makes the eventual crack in it so surprising. If the Fisher effect held perfectly, monetary policy would be almost mechanically simple. Nominal rates would track expected inflation closely and predictably. Real interest rates, the number that actually matters for whether borrowing is genuinely expensive or genuinely cheap in a meaningful purchasing power sense, would stay relatively steady, moving only when the Fed deliberately wanted to tighten or loosen policy. Under this theory, the Fed's job would essentially be reading a well-calibrated instrument. Watch the nominal rate, understand that it's already absorbing inflation expectations 1-for-1, and adjust policy with confidence that you understand what's actually happening underneath the surface number. This is the story taught in a huge number of introductory economics courses. It's clean, it's intuitive, and it fits beautifully with the thermostat metaphor everyone already uses. It's also, according to decades of empirical research, only sometimes true. Here's where theory runs directly into something messier and far more interesting. Empirical studies looking at the actual relationship between nominal interest rates and expected inflation find something genuinely strange. The Fisher effect is strong in some periods and almost completely absent in others. Over long time horizons, spanning years or decades, inflation and nominal rates do tend to trend together, roughly as the theory predicts. But over shorter horizons, the kind of timeframes that actually matter for day-to-day policy decisions, the relationship often breaks down almost entirely. Sometimes nominal rates barely move even as inflation expectations shift meaningfully. Sometimes nominal rates swing around for reasons that seem to have very little to do with inflation expectations at all. The clean, one-for-one relationship the theory promises shows up reliably only when you zoom way out. Zoom in to the time frame that matters for actual policy meetings, and the signal gets noisy, inconsistent, and frankly unreliable. This inconsistency has a name in academic economics, and it's a name that deserves to be far more widely known than it currently is. It's called the Fisher paradox. Economic theory says nominal interest rates should tightly track expected inflation. The actual data says, not reliably. Sit with how strange that is for a moment. This isn't a fringe, contested idea in economics. It's a well-documented empirical pattern, sitting right at the foundation of how central banks are supposed to interpret the single number they watch most closely. The theory is elegant. The data politely, persistently refuses to fully cooperate with it. And here's the deeper implication, the one that should genuinely reshape how you think about every Fed announcement you've ever half-listened to on the news. If nominal interest rates don't reliably, cleanly reflect expected inflation, then nominal rates aren't a clean thermometer reading at all. They're a noisy, contaminated signal, one that's mixing together several different things at once, without telling you clearly which ingredient is driving the number at any given moment. So what exactly is contaminating this signal? What else is baked into that single nominal rate number besides expected inflation? Nominal interest rates reflect risk premia, the extra compensation lenders demand when they're worried about default, uncertainty, or instability, completely independent of what they expect inflation to do. They reflect monetary policy surprises, sudden shifts in expectations about what the Fed itself is about to do next, which can move rates for reasons that have nothing to do with the underlying economy's actual temperature. And they reflect changing beliefs about the future more broadly, shifting confidence, shifting uncertainty, shifting narratives about where the economy is headed. All of that gets bundled together into one single number, the nominal interest rate. Expected inflation is in there, but so is fear, so is uncertainty, so is pure speculation about what policymakers might do next. If the Fed treats that bundled, noisy number as a clean temperature gauge, it can systematically misread what's actually happening underneath the surface. This is precisely the kind of hidden complexity we've explored throughout this entire channel. An elegant, simple-looking number, quietly hiding a mess of tangled signals underneath it, the same way an elegant equation can hide fragile assumptions, or a calm market can hide accumulating stress. Now let's connect this directly to real, practical consequences, because this isn't just an academic curiosity. It shapes how monetary policy actually plays out in the real economy. When the Fisher effect is weak, meaning nominal rates aren't cleanly tracking inflation expectations, a rise in nominal rates might not actually mean tighter policy in real terms. It could simply reflect rising inflation expectations, with the real interest rate, the number that actually matters for whether borrowing is genuinely expensive, staying roughly unchanged, or in some cases even falling. Picture what that means from inside the Fed's own decision-making room. They raise the headline rate, expecting that action to meaningfully cool down borrowing and spending. But if that rate increase is mostly just catching up to rising inflation expectations, the real, purchasing power-adjusted cost of borrowing may have barely moved at all. The dial looks like it's been turned. The actual temperature in the room hasn't changed nearly as much as the dial suggests. Here's the mirror image version of the same problem, and it's arguably even more dangerous because it points in the opposite direction from what most people intuitively expect. Low nominal rates can coexist with very tight real policy if inflation expectations have collapsed. Imagine a scenario where the headline interest rate looks low, even generous, by historical standards. Financial commentators might describe policy as loose or accommodative. But if inflation expectations have fallen sharply, if people genuinely expect prices to stay flat or even fall, that same low nominal rate can represent an unexpectedly high real rate, meaning borrowing is actually more expensive in purchasing power terms than the headline number suggests. In that scenario, the Fed can look from the outside like it's keeping the thermostat generously warm, while the real economy is quietly, invisibly freezing. Let's make the metaphor as precise as possible, because precision is exactly what's missing from how this usually gets discussed. The Fed isn't blind. It sees the number on the nominal rate thermometer clearly, precisely, in real time. What it can systematically misinterpret is what that number actually means for the real economy underneath it. It's not a broken thermometer in the sense of displaying random garbage. It's a thermometer that's measuring something slightly different than what everyone assumes it's measuring. A blend of inflation expectations, risk premia, and shifting beliefs, all fused together into one deceptively simple-looking reading. This is a subtle distinction, but it's the entire point of this video. The number isn't fake. It isn't manipulated. It's just measuring more than one thing at once, while being treated in practice as though it measures only one thing. This noisy thermometer problem helps explain two genuinely strange patterns that show up again and again in monetary policy history. First, it helps explain why rate hikes sometimes cause the very slowdowns they were meant to prevent, rather than the moderate cooling policymakers intended. If the real terms tightening ends up larger than the Fed anticipated, because inflation expectations were shifting in ways the nominal rate wasn't cleanly capturing, a policy move calibrated for a gentle cooldown can land instead as a much harsher freeze. Second, and closely related, it helps explain why the so-called neutral rate, the theoretical interest rate that neither stimulates nor restricts economic growth, is notoriously, persistently difficult to pin down in practice. If you can't cleanly separate expected inflation from everything else bundled into the nominal rate, you can't cleanly identify where neutral actually sits at any given moment. The target itself is blurred by the same noise contaminating the thermometer used to find it. Now here's where this video takes a genuinely strange turn, one that connects the metaphor of temperature back to something startlingly literal. Research has found that actual ambient temperature, real weather, the kind you feel outside your window, measurably affects financial decision-making. Specifically, a 10% increase in temperature has been shown to shift how optimistically investors allocate their money between stocks and bonds, with the size of that effect varying depending on individual personality traits. Let that sit for a second, because it's a genuinely strange finding to place next to everything else in this video. We've spent this entire script talking about interest rates as a metaphorical temperature gauge for the economy. It turns out actual, literal temperature, sunlight, warmth, the weather outside, independently, measurably nudges human risk-taking behavior, completely separate from whatever the Fed is doing with its dial. Here's the irony worth sitting with, because it's the emotional and intellectual center of this entire video. The real thermometer, actual outdoor temperature, whether sunlight measurably, directly changes human financial behavior. It's a genuine physical signal with a genuine physical effect on how optimistically or cautiously people invest. Meanwhile, the policy thermometer, the nominal interest rate the Fed watches so closely, the number everyone treats as the clean, authoritative measure of the economy's temperature, is itself a distorted, noisy signal, tangled up with risk premia and shifting expectations that have nothing to do with the underlying real economy's actual state. In other words, the metaphorical thermometer is broken in subtle, hard-to-detect ways. The literal thermometer, the weather outside your window, is quietly, measurably doing exactly what a thermometer is supposed to do, influencing behavior directly, reliably, and almost nobody's paying attention to it. Here's why this matters beyond being a strange piece of trivia to file away. Every financial decision, every investor choosing between stocks and bonds, every business deciding whether to expand, every household deciding whether to take on a mortgage, is being shaped simultaneously by both of these signals. The noisy, contaminated nominal rate signal the Fed is broadcasting, and the literal physical weather quietly nudging individual risk appetite in the background, invisible to any policy model. The Fed's models generally account for the first signal, imperfectly. They essentially never account for the second. That's not necessarily a flaw in the models. Weather-driven behavioral noise is genuinely hard to systematically incorporate into monetary policy. But it's a reminder that the temperature shaping economic behavior isn't a single, clean number at all. It's at least two entangled signals, one policy-driven and imprecisely measured, one literal and almost entirely ignored. If you've been with this channel since the beginning, this pattern should feel deeply, uncomfortably familiar by now. Our Black Skulls video showed you an elegant model whose clean assumptions quietly broke down under real-world pressure. Our Bitcoin video introduced the idea of economic temperature as something genuinely measurable, using Landwehr's principle to describe fee markets mean reverting like a physical system cooling toward equilibrium. Our Fisher equation video showed you a 100-year-old conservation law hiding in plain sight, largely ignored by the very field it should have reshaped. This video adds one more entry to that same pattern, and arguably the highest stakes one yet. The single most powerful economic institution on the planet uses a temperature metaphor to describe its own core function, and the thermometer underneath that metaphor is measurably, persistently noisier than the clean story most people, including plenty of finance professionals, assume it to be. So here's what I want you to actually walk away with. This isn't a claim that the Federal Reserve is incompetent or that monetary policy is some kind of elaborate illusion. Central bankers are working with genuinely difficult, genuinely noisy information, doing the best job that's realistically possible with an imperfect instrument. That's a very different claim from saying the whole system is broken. What this is a claim about is something narrower and more useful for how you personally interpret financial news going forward. The next time you hear that the Fed raised or lowered rates, resist the urge to translate that headline number directly into the economy just got meaningfully hotter or colder. The relationship between the number and the real underlying temperature is genuinely, persistently noisier than the thermostat metaphor implies. Sometimes a rate hike barely moves real conditions at all. Sometimes a small, cautious-looking move represents a much larger real shift than the headline suggests. If you're trying to actually understand where monetary policy stands at any given moment, the nominal rate alone won't tell you. You need to look past the headline number, toward measures of real interest rates, nominal rates adjusted for actual, current inflation expectations, to get a clearer read on whether policy is genuinely tight, genuinely loose, or somewhere confusingly in between. And it's worth holding onto a little epistemic humility here too. If professional economists, with access to enormous datasets and decades of research, still struggle to reliably separate the signal from the noise in this single number, that's not a reason to distrust economics entirely. It's a reason to treat confident, simple headlines about the Fed's next move, With exactly the kind of careful skepticism this entire channel has tried to model, video after video. The Fed isn't lying to you when it talks about setting the temperature. But the thermometer it's reading from is quietly, measurably noisier than the metaphor lets on, mixing inflation expectations with risk, uncertainty, and shifting beliefs, all fused into one deceptively simple number. And somewhere just outside the frame of every policy meeting, the actual weather is quietly nudging investor behavior in ways nobody in that room is measuring at all. 2 thermometers, only one of them is reliable, and it isn't the one everyone's watching. If this kind of thinking, where physics quietly explains the parts of finance nobody else is willing to explain, is why you're here, subscribe. New videos every week, breaking down the hidden math behind money. See you in the next one.